Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Exxon Mobil Corporation, ticker XOM. I love bringing you guys analysis on stocks that are undervalued that I feel like are a buy, but on the other end, we have some stocks that are undervalued that I feel like are worth selling, and this would probably be one of them. As we go through the growth prospects for this company, it's peaked. And we'll see all of that through the graphs. It's pretty obvious. I owned some of this as a dividend stock a while back, and I'm glad that I do not hold it anymore. So let that be a warning. It's probably looking like a yield trap when it comes to dividends. So I'm coming up with a fair value of $122. Discounted cash flow is $140, so somewhere in that $130 range would be a decent price. It's currently sitting at 105. It's gone as high as 126 in the last 52 weeks and as low as just about 98. Earnings yield 7.22%. Decent. I mean, for that, what we're paying, we'd want to see 5.27 for our earnings per share. And when we go take a look at the metrics, we see this year we're expected to do 698 and next year 837. So earnings wise, it's reasonable. Cash flow yield is down 9%. 11.7 is the average for the last 5 years. So I don't like the trend there. I mean, even if we come down, last 3 years and 2 years have just been on a decline. So they had really good cash flows at the start of this period and have been declining since. To be fair, there was some revenue decline as well. Dividend yield 3.55%, on average 4.91. So they've got a pretty high dividend yield. Payout ratio, right where we like to see it for dividend stock. So I would definitely classify this as such. About 47% off of last year's earnings and almost 53% off this year's, because EPS this year is expected to be lower than last year. Now ROE looks good, 12.77. Debt to equity isn't too out of hand, 0.69. ROI is decent, 9.4. ROA, it's okay, 7.4. So the returns are not bad. Margins a little low, 22.63, on average 24.24. Net 9.94, on average 10.74. They do have a lot of competitors, and that's probably why we see lower margins, but at least they're around that 10%. 10% net is really the minimum of what we'd like to see, and they're right about it. PE of 15 and a PEG of 0.76. So earnings, strictly off the earnings, it's a reasonable purchase, reasonable price. But that's not everything that there is to a company. Strictly off the dividend, it seems pretty reasonable. Pretty high yield, right around the payout ratio that we like to see. But then you look over their historical performance and what analysts are projecting going forward, and things do not look very good. Revenue decline, cash flow decline, issuing shares, very fast slowdown in the growth of the dividends. I'm giving them the benefit of the doubt here. Analysts in 2 years are projecting 0.2% revenue growth, so I'm going with 0.2% revenue growth. Flat would probably be fair for this, especially when we go look at the financials here. We see it's really flat. I mean, you get a little bit of up and down, but there's not a whole lot of change here. And that's what we see across a lot of the graphs. I mean, at least they have some ability to alter margins. So you saw that they got their gross profit up in 2022. It was definitely their better year for revenues as well, but have been on quite the decline since then. And if that continues, it's not looking too hot. Balance sheet. I mean, we see decent growth there. Liabilities are pretty flat. That's what we like to see. Nice tangible book value. So the balance sheet is in good shape here. Cash flows, flat. 2022 was an outlier. Aside from that, just flat. Dividends, really nice growth from 21 to 22, and then pretty much flat from then forward. And if we take a look at all of the valuation metrics, the dividend, flat. Earnings dropped off and then flattened out. The actual share price has actually come up to in 2024. So last year was pretty close to the fair value, and right now it's just sitting below it. It's kind of on its way back down from the way that things are looking. Cash flows peaked, decline, flat. Balance sheet is one of the best things that they got going for them here. Just up and to the left like we like to see it. They got balance sheet. Share count, I mean, over the last 2 years, they've averaged 2% a year. I'd like to see them come in lower than that. So somewhere between 1 and 2, 1.5 might be a little high, but we'll see how things work out with that. Cash flows, I would just like to see them positive in some sort of way. I know revenues are expected to be barely growing, but like cut some costs or something and get those cash flows up. Assets, 7% this last year, will go 7%. Liabilities, same story there. They're pretty consistent, 3 to 4% growth in the liabilities. Assets definitely got a lot more going for them. Dividend, I mean, 1.5 might be a bit high, but if they continue this 1.5, in 5 years, you'll be looking at a $4 dividend, and that's a 3.8% yield on cost for what you're getting today. I don't think it's worth that kind of risk. And then margins, I'd just like to see it get up above 10%, and a 0.1% growth would get it there within the next 5 years. So it's definitely undervalued. Somewhere in the realm of $20 to $30 per share. It just doesn't have the growth to support. This thesis is coming out to annual growth of 3.3%. Once you factor in the dividend, you got 6.8%, which means you're underperforming the market by somewhere between 1 and 3%. If it were to turn around, improve, and reach its fair value, then in 5 years, you'd be on par with the market here. And we don't really like on par with the market. We like to outperform. So I definitely don't want to touch this one. I'd wait for a bit of a turnaround. Things that I would specifically look for is revenue growth outpacing inflation at a minimum. 2% there isn't too much to ask for. Shares not to be issued. Cash flows to be positive as well. Don't even have to be above 2%, just have to be positive. So these three are the main things that I would look for to see how things are shaping up and if it would be worth getting in as a turnaround play. Because at the moment, it's in free fall. Revenues are declining, shares are getting issued, cash flows are falling. There's a pretty big drop in the earnings from what they had experienced previously. Like, analysts do not have a lot of faith in them this year. And it's trading at a pretty fair value for the earnings. So the market might not like that either, especially with everything that's going on with the market in total. This is definitely one that I would try and steer clear of and would make my stocks to sell list for the month. But I want to thank you guys for watching. Please like and enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. I'll catch you next time.